Take a look at what happened with the positions. We'll mention last Friday, we had a news event, which happens from time to time, and we had a relatively large down day, which happens from time to time. This is normal. It's nothing to freak out about, so always keep that in mind. We'll discuss how to handle that. As you get deeper into the membership, you'll understand more how to handle these things. But again, this does happen. Of course, we bounced here on Monday, but let's take a look at this position. One of the things that I want you to notice is,
before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
I don't know I don't know how all of you are positioned. Some of you may have been in broken wing butterflies or more neutral flat trades and had a problem with this move. Notice the bull trade had no problem with this. You want to understand what you're doing. Like when you enter the market flat delta and the market goes up, you end up like most of the trading strategies. Like if you're flat delta, you usually end up taking on more downside risk to deal with the fact that the market's going up, either because the trading strategy tries not to lose money when the market goes up, or it tries to win more money when the market goes up, right? So either of those concepts. So what you're doing is you're entering neutral and you're taking on down risk as the market goes up. You're still taking on down risk, right? And this is either from a delta perspective or from an applied volatility perspective. You're still taking on downside risk. You're just taking on downside risk after the market's gone up. It makes it more likely that you lose doing that than if you take on down risk before the market goes up and then just let the down move happen, right? This is a perspective change that I've seen this for 15, 20 years since we've started educating traders. It's like they won't enter a bullish vertical because they can see that if the market goes down, they might lose money. So they enter the market flat. They see is when you flat and the price goes up a lot and you want to make money, you have to take on downside risks to make money to the upside. So if you think about the normal market cycle, it goes up and then it goes down. It goes up and then it goes down. If you think about the normal market cycle, you're better off taking that risk before the market goes up rather than after the market goes up. Like you would have been better off taking the risk there. Okay. So it's almost counterintuitive. It's like a lot of times when I'm concerned about a down move, I'd rather be in a bullish position than a flat position because of that dynamic, right? So this is kind of like the case here, right? So if I go into Friday, there were no adjustments, but on Friday, this position is, up at its maximum P&L, but it's not hurt, right? In other words, this move isn't a problem at all. Where in some of your flat positions that you forced to adjust up to maintain your bullishness, that is a problem. Okay, so just keep that dynamic in mind. It's like when you're entering flat delta and you're hoping, right? And it's like you're almost hiding you losing scenario from yourself. Like if I understand my flat delta trade, I understand that it still has a losing scenario. It's just different than if I just did a bullish vertical. My losing scenario is just different, but it's still there. But what tends to happen is a newer trader coming in particular will see they can clearly see. It's like you can clearly see that if I enter the trade and the market goes down to this point, that, right? Because if you think about the trade rules, I don't do any adjustments. I just wait till it stops out, right? So you can clearly see in your mind when that trade might lose. But what happens is they'll go into a flat delta position that has all these adjustments to it. And there'll be this initial impression, like especially if you don't understand what you're doing, you don't understand the trades, there'll be this initial impression that the trade can't lose. or you don't, that losing scenario isn't blatantly looking at you. But that doesn't mean it's not there. It's just, it means it's there, but you're ignorant to it because you're not educated enough yet, right? Once you become educated enough, you realize that if I enter flat, I still have a losing scenario that might play out for the duration of the trade, right? My point being is that it's always there. And if your goal is to eliminate the losing scenario, you can't. Losing scenario is always there. It's better off to understand what that losing scenario is, and then select it more intelligently. Like, oh, the market's been down a lot. I want to be in a bullish vertical because it's been down a lot. The market goes up and the market goes down. It's been down a lot. There's a decent chance it's going to be going up. I will risk on my entry losing if the market continues to go down. That's a more probable decision to work out for you than I'm afraid the market might continue to go down. I'm going to enter flat. And then when the market goes up, think about what you're doing with your adjustment strategy. And then when the market goes up, I'm going to take all this downside risk. And then if the market goes down at that point, then I lose. Where if I took the bullish one on the initial start, and when if it came back down to here, it's not a problem, right? So there's this whole dynamic going on underneath that we should understand. If we're trading, it's going to make you 1,000% better trader if you understand that dynamic and you play on it. Okay. So anyway, here we're just doing trades as examples, right? And we're seeing what happens. Obviously on Friday, this recovered. This is the other dynamic about a flat delta trade. I get a big down move. I have a volatility thing that happens that usually draws down my P&L. Then I go flat delta, right? So this is the other scenario, right? I get in the trade, I do get the down move. Well, after a down move, I'm probably going to get an up move. So, but I get the down move and I get a P&L dropout, and then I flatten my delta again. And then when I get the bounce, I don't recover from the down move. Now I'm caught in trading I'm caught fighting to get my money back. Where here, I get the down move, I get a bit of a drawdown. If I get my up move, right? We'll just look at Monday. We usually don't look at Monday. I get my up move, I'm pretty much back where I was before. Okay. And it's a lot less stressful. I might have been a little stressed because I lost some P&L, but I didn't have to make any adjustments. I didn't have to go flat, and then I have to chase it to the upside. I didn't have any of that. Okay. So keep that in mind. There are easy ways to trade and there's hard ways to trade. Easy ways to make money, harder ways to make money, more probable ways to make money, less probable ways to make money. And the probability isn't based off of these numbers, these delta numbers, like people think it is necessarily that you're going to make money. Okay. So just keep that in mind so that you can advance.